Everyone loves SCHD for its dividends. But here's the tough truth. If it's your only ETF, your portfolio might be quietly falling behind. Let's talk about building a smarter portfolio using just 3 ETFs. One that pays dividends, grows with the market, and stays strong in any economy. Now, I want to be clear. I'm not here to hype up theories or give you wishful thinking. This is a real, practical strategy, and it's backed by actual data. In this video, I'll show you how I built a 3 ETF portfolio with SCHD at the core, and more importantly, why that choice makes sense. Because yes, SCHD is strong, but relying on it, that's where most investors go wrong. In fact, here's a hot take. Putting all your money in SCHD might be the most overrated strategy on YouTube right now. So let's break this down. You'll leave with a complete, easy-to-follow portfolio that covers income, growth, and global exposure. Let's get into it. Chapter 1. Why SCHD is the core of my portfolio. Let's start with SCHD. It's short for the Schwab US Dividend Equity ETF. Now, why is it the core of my portfolio? Simple. It brings a powerful mix of quality, income, and reliability. SCHD holds over 100 blue-chip US stocks. These are not risky bets. These are large, profitable businesses. We're talking about companies from sectors like financials, healthcare, energy, and industrials. But what makes SCHD really shine is its dividend performance. It has a 10-year dividend growth rate of 11.04%, and over the past 5 years, it's grown at 11.59%. That's not just good. That's inflation beating, portfolio growing, income you can count on. The current yield? Roughly 3.5 to 3.6%. That's about 3 times more than what you'd get from the S&P 500. And the cost to own it? A tiny 0.06% expense ratio. Basically $6 a year on a $10,000 investment. Now here's the fun part. Many of SCHD's companies are quietly benefiting from the AI boom, even though nobody's really talking about it. Why? Because AI makes them more efficient, and efficiency boosts profits, which eventually means bigger dividend checks. So in short, SCHD gives me strong dividend growth, quality companies, and low fees. That's why it's my core, but that doesn't mean it's perfect. Let me show you where the cracks begin to show. Chapter 2. Limitation number 1. Sector gaps and concentration risk. On the surface, SCHD looks diversified. It owns over 100 companies. But dig a little deeper and you'll see a real problem. It's just too concentrated in just a few sectors. As of early 2025, over 40% of SCHD was invested in just 2 areas: energy, 21.08%, and consumer staples, 19.06%. That's a big red flag. Because if either of those sectors hits a rough patch, your entire portfolio suffers. You're not as protected as you think. Here's another issue. Some key sectors are almost missing. SCHD has only around 10% exposure to tech and less than 0.05% in utilities. Communication services, just 4.81%. And that matters because sectors like tech and utilities have driven a lot of recent market growth. Utilities also tend to offer stable, high-yield dividends, something dividend investors usually love. So while SCHD gives you strong dividend stocks, it also exposes you to sector risk you might not even notice. It's like wearing armor, but forgetting the helmet. This leads right into the second big limitation. Chapter 3, Limitation number 2. Missed growth opportunities. Let's talk about growth, because this is where SCHD really falls short. Over the past decade, SCHD delivered a 10.56% annual return. That's solid, no doubt. But compare it to a NASDAQ 100 fund like QQQ or QQQM, that return? A massive 17.71% per year. Let's put that into real numbers. If you invested $10,000 in SCHD, you'd now have about $27,300. But in a NASDAQ 100 fund, that same $10,000 would be worth over $51,000. That's not a small gap. That's life-changing wealth left on the table. The reason? SCHD doesn't focus on high-growth companies. It leans towards value and dividend payers. That means it often skips out on big innovators like Apple, Nvidia, Amazon, and Microsoft, the companies that have redefined entire industries. Now, don't get me wrong, dividends are great, but if your portfolio has zero growth fuel, you're just walking slowly while others are racing ahead. So yes, SCHD gives you stability, but without growth exposure, it may delay or derail your retirement goals. Chapter 4. Limitation number 3. No global exposure. Now let's talk about geography, because SCHD has another blind spot. It's 100% invested in US companies. That's right, zero international exposure. And that's a problem. Why? Because the US makes up only about 40 to 50% of the global economy. That means SCHD ignores the rest of the world. It's like trying to win the game while sitting out half the match. Look back at 2000 to 2009. The S&P 500 had a negative return during that entire decade. Meanwhile, international markets, especially in emerging economies, did well. So if your portfolio was all US, you struggled. But global investors actually made money. SCHD keeps you locked into one country. And when the US stumbles, you've got nowhere else to run. That's why we need something more. And this is where ETF number 2 comes in. Chapter 5. ETF number 2, VXUS, Global Diversification. Enter VXUS, the Vanguard Total International Stock ETF. This one fixes the global gap. VXUS invests in over 8,500 companies outside the US. We're talking about giants in Europe, Asia, and emerging markets. Its top regions include Europe at 40.3%, the Pacific at 25.3%, and emerging markets at 26.4%. And its holdings are impressive. Companies like Nestle, SAP, and Taiwan Semiconductor, names you won't find in SCHD. The goal of VXUS is simple. Give you broad international exposure and do it cheaply. It only costs 0.05% per year. That's just $5 on a $10,000 investment. Now, it's true. VXUS hasn't had huge recent returns. Its 10-year CAGR is 5.61%. Not as flashy as US tech, but that's not its job. It's here to balance risk. When the US underperforms, international markets often shine, and VXUS helps you stay invested globally, no matter what happens at home. So together, SCHD and VXUS give you income and worldwide coverage. But we're still missing something big: growth. Chapter 6. ETF number 3, QQQM, Pure Growth Engine. Let's bring in the final piece, QQQM. This ETF is all about one thing and one thing only: growth. QQQM tracks the NASDAQ 100, which includes the 100 biggest non-financial companies on the NASDAQ exchange. That means it's loaded with tech giants and innovators. Think Apple, Nvidia, Microsoft, and Amazon. It's basically the engine of the US stock market, and the results speak for themselves. Over the past 10 years, QQQM and its twin QQQ returned a massive 17.71% annually. A $10,000 investment would now be worth over $51,000. Now, yes, growth comes with risk. In 2022, QQQM dropped over 32%. That's the trade-off. But for long-term investors, the payoff has been huge. Also, QQQM has a small but useful edge. It's cheaper than QQQ. The expense ratio is 0.15% versus 0.20%. That difference adds up over time. By adding QQQM, you build what's called a barbell strategy. On one end, SCHD gives you income and stability. On the other, QQQM gives you speed and scale. So now with SCHD, VXUS, and QQQM, you've got a complete portfolio: income, global reach, and powerful growth. Chapter 7: Suggested Allocation Strategies Based on Life Stage. Now let's put all of this together, because just knowing the ETFs isn't enough. You need a plan, a smart allocation that fits your life stage. Strategy number 1: let's start with someone in their youth, who is in his 20s, just started working, retirement is decades away. He wants to grow his money fast and can handle some bumps along the way. For him, a strong setup would be 40% QQQM, 30% VXUS, and 30% SCHD. This would give him maximum growth, global exposure, and just enough dividend income to stay grounded. Strategy number 2. Now our second strategy is for someone who is in his 40s. He has a family and is focused on building a stable retirement. He wants growth, but also some peace of mind. An ideal mix might look like 40% SCHD, 30% QQQM, and 30% VXUS. Here, SCHD takes the lead. It adds income and stability, while QQQM and VXUS balance things with growth and global diversification. Strategy number 3. Our final strategy is for people who are nearing retirement and thinking more about income and protection. Growth still matters, but risk? Not so much. A suggested setup: 50% SCHD, 30% VXUS, and 20% QQQM. This mix focuses on dividend income, global safety nets, and just a dash of growth to beat inflation. So whatever stage you're in, there's a mix that works. You just have to build it intentionally. Chapter 8: Alternative ETFs. Now, maybe you want even more income, especially if you're nearing retirement. In that case, here are 2 solid alternatives. First is JEPQ, the JP Morgan Equity Premium Income ETF. It yields around 11% and pays monthly. It's heavy in mega cap tech and uses covered calls to generate income. Then there's UTG, the Reeves Utility Income Fund. It yields 7%, has strong utility and communication stock exposure, and pays monthly as well. These aren't replacements, but they can boost cash flow, especially if you're building a portfolio focused more on current income than growth. Use them wisely and adjust based on your needs. So there you have it, a 3 ETF portfolio that actually works. SCHD gives you quality and dividend growth, VXUS brings global diversification, and QQQM adds the growth fuel your future needs. Whether you're just starting out or nearing retirement, you now have a model you can adjust to fit your goals. And remember, SCHD is powerful, but on its own, it's like trying to build a house with just a hammer. Add the right tools, and now you've got a full financial toolkit. Let me know which mix fits you best, and I'll see you in the comments.